Markets are crashing straight through must-hold areas of support, mostly in the Nasdaq after mixed labor data from Friday morning. And as noted on Wednesday, it looks like we continue to see broad-based weakening, and therefore I would continue to expect just as much volatility this week, especially with the upcoming inflation reports. So welcome to the Trade Brigade Weekend Show, where we'll build a technical trade plan and continue talking about some of the fundamental drivers behind the market. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid red-bodied bar with very minimal upper and lower wick to read into, nothing there psychologically. A very strong close from the sellers, dead on the lows of the weekly range. So structurally, bears are definitely in control. If we're thinking about location on the bar-to-bar count, we do have ourselves a lower high as well as a substantial lower low. So bears go 2 for 2 on the bar-to-bar count. But what do we know about the overall context here? We're technically pulling back from an equal high in the grand scheme of the trend, and it's very possible that a higher low could be found above the August 5th panic low. But if we think about the structural analysis from quite literally seconds ago, there's no large lower wick on this bar. There's no current indication that buyers are trying to step up and offer this higher low to preserve the weekly trend and keep it in the upward direction. So let's check in on some reference points and see if we're over or under these key levels. Well, from a Fibonacci perspective, we've certainly closed underneath the 38.2, which of course is slightly more bearish than bullish. A better looking weekly bar could have looked something like this, with a longer lower wick and a close back above the 38.2. Obviously that did not take place, and once again we're acknowledging the slightly more bearish shift in tone here. If we bring out the anchored VWAPs on the weekly time frame chart, it's the same exact concept. Remember that these were basically confluence around 545, 544. We can also check in on the high volume node from the weekly volume profile. And what we'll do is we'll just drop this down to a 9-month chart, so we're not looking at so much data. But remember that this high volume node was somewhat aligned with all of those other inflection points we were just talking about, around 545, and we've closed underneath. So what would that imply? All of this is possibly going to act as overhead supply, and we've got a low volume void to rotate through with the next possible target coming in closer to 530. So would it be unreasonable for the weekly chart to continue in the downward direction towards 530? I think the answer is no. That would be a reasonable outcome into the upcoming week's worth of trade. And if this chart was going to turn around and produce something more constructive in the upward direction, ideally I'd like to see a close this upcoming week towards the upper third of this previous weekly bar. And just currently based on structure and the lack of a lower wick, I'm not necessarily convinced that that's ready to take place. A larger concern would step in on the weekly time frame when and if this ultimately triggers as a double top, which would require a move underneath the neckline, the August 5th lows, which are much closer to 511. That's not really in force for the upcoming week's worth of trade. Let's bring it on down to a daily time frame chart and see what else we can learn with a little bit more granularity. So here's the weekly expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 553.34, implying a lower high on the daily time frame chart. And if we're contained by the lower bound, the number is at 527.41, and that's actually underneath one of the only other important reference points coming from the hourly double bottom neckline over here. That, of course, is bearish, so the expected move is not even neutral by any stretch of the imagination here, and it certainly far expanded outside of last week's expected move. This was kind of comical, seeing how small this was. Notice that we've closed on something like a 2 or 3 sigma move outside of last week's expected move, given that we had multiple catalysts, right? It was also a shortened holiday week that the options market was pretty inefficient in terms of pricing and the potential movement there. So regardless, daily trend is what here? Because this is where we start to talk about being stuck between a rock and a hard place. From point A, way down here, August 5th panic, all the way up to these most recent highs, we'll call this point B. this was actually an uptrend, and we know that if we add in some context with point C. From here to here, we had a technical higher high, and therefore it's not fair to continue calling this a downtrend. But as of right now, we've certainly broken down from this overhead balance. That really took place on Tuesday. Notice on Wednesday and Thursday, both of the upper wicks in both of those bars rejected 550-550, indicating that this is truly acting as overhead supply and there was downward pressure forced into the market. Now, if you recall, we were looking for interactions around this previous gap. Is there anything based on Friday's structure that is suggestive that the gap fill reversal started to step in? The answer is absolutely not. We clearly closed well underneath the closure of the gap at 544.85. We clearly broke down away from the daily 50 SMA. So although it's still possible that you could get a higher low from point A to, let's just say, point D over here, considering we've used B and C already, I would say this is the line in the sand, right? 537 is the line in the sand. You need to find, if you're trying to remain bullish, a higher low here that keeps you inside of and somewhat above the bottom end of this previous balance from over here. If you break down below point D, I would really start to think that the daily trend is more severely down or starting to flip more neutral. If we support off of point D, rock in a hard place, right? Any sort of rally attempts can still find daily lower highs now underneath the bottom end of this balance range. So the daily chart is not really so clear in terms of the overall trend that's here. And you could really start to see this if you just draw in an overall range that looks like this. We're quite literally close to the midpoint, right? Close to the midpoint, you generally do not have any sort of major edge. Your edge quite literally exists at the edge and at the edge, breakout, breakdown, or mean reversion and mean reversion. So let's start to get a little bit more granular and see what's going on the hourly time frame chart and how we might be able to build some trade plans off of the action that we've seen last week. So I, of course, want to reinforce, here's an overhead range. We had highs, lower highs have been found underneath. We had lows, we found lower lows underneath. The hourly trend is certainly down. The next thing I want to point out is that, recall, this was the gap over here, and this speaks to the type of participant in this market. On the Thursday session, we looked into the gap, but technically closed above the top of the gap at 549. And on Friday, we also opened over 549. So if this was truly going to be a look below and fail, and if the sellers were not going to have much momentum here, this open on Friday was basically a gift to the buyers. There was thin structure, and on the first attempt, sellers could not close the gap all the way. So, okay, if buyers get the open back above the level, we would think that subsequent holds of 549 should rotate at least into 550, 550, and we can clearly see what happened on Friday. That was not the case. Stronger dip buyers are not stepping up in this market, and this is also what we described based on the internals in Wednesday's midweek market update last week. So as we're looking forward, what do we have on tap for the upcoming week's worth of pathing? Well, because we're in an hourly downtrend and because we're basically sitting on the lowest low of the hourly downtrend, I would tend to think that trying to fish for brand new money shorts dead on the lows is not the wisest decision here. I would want to see some sort of interaction with the daily line in the sand higher low. It's at 537, and my preference would be looking for a rally attempt off of that, then reevaluating the chart at 544.85. Can we spot some sort of hourly lower high? In which case, we are trading back in the downward direction to the equal low, and then looking for follow through in the downward direction, ideally, into what could be considered the double bottom neckline from back here at 529.50. That would be what the bears want to see from a respectful risk-reward perspective. Ideally, you'll offer some sort of lower high, so risk can be managed. You can look for that original range, and then you would look to exploit runners into this next level, 529.50. If you're a stronger bull, you've really got a lot of work to do here in this market. Not only do you need a counter trend move to 544.85, you likely need to go through that. You need to go through 549, and you need to find a higher low up here, in which case maybe by some sort of stretch of the imagination, we start to suggest, okay, there's maybe an inverted head and shoulders. Do I feel as though that's a high probability outcome early on in the week? Likely not. Because of the bearish momentum and because of all of the supporting evidence we're about to see as we walk through today's video, I would tend to think there are lower odds of this higher low over 549 into the early stages of the week, which would then set up some sort of break in the upward direction. As we talked about on the daily time frame chart, even if that move were to unfold, let's say that we find some sort of double bottom over here, some sort of retracement in the upward direction, what are we doing at 550, 550? I want to be very clear about this. This is massive overhead supply. On the daily time frame chart, there is a threat of a lower high, and that would subsequently change the daily trend to possibly down. So certainly mindful of 550, 550 if there's any attempt to get there in the first place, but you guys know my thoughts. Mainly this, looking for a lower high here, trade to the equal low, you could get another lower high or something of the sorts, but generally looking for 529.50 coming from the double bottom neckline back here off of the August 5th reversal. Let's take a look quickly at the anchored view apps intraday to see what else we can learn about the activity. Another supporting piece of evidence for the bears, the August 5th anchored view app offered zero support intraday. Nothing on that Friday session. Notice that the Tuesday breakdown anchored view app offered resistance on the Friday morning session, and Tuesday just smashed right through. This was a Thursday gap up. That anchored view app has been just completely eliminated. At this point, if there is some sort of harsh reversal in the upward direction, if there is some sort of clearance of this 549, I would still be thinking about, once again, how this is possibly confluence with 550, 550, a pretty bearish spot based on everything we've seen so far. Final thing on the hourly chart before diving into some more supporting evidence, let's jump in with the Fibonacci's. And what do we see? The 38.2, that would keep us somewhat underneath the top of the gap from back here at 549, reinforcing that level. The 61.8 is not really offering what I would ideally like to see, which would have been closer confluence to this up here at 550, 550, but we'll take that in stride. For now, I would tend to think that this is your lower high threat. This to this could be a lower high threat, and if there is going to be any sort of major movement in the upward direction, it would have to be a recapture of that 549 as we've already described. Let's jump on into the market internals. For the nicey side of things, if you're not familiar with this dashboard, take a look at the video tutorial in the top right hand corner. If we think about Friday's session, as that large breakdown was taking place, did we see substantial bearish internals? Volume flows say yes, absolutely, it was bearish. The advanced decline line opens up over zero and then closes near trend lower zone. The index score all day was very weak. Yes, absolutely bearish here as well, confirming that downward pressure. What do we see out of the cumulative build? It was a sustained build throughout the session. It was not some sort of liquidation break that faded into the afternoon, looking different in terms of shape. And the read by the end of day was negative 4,300, not quite at the 5,000 mark that we typically look for, but generally speaking, the market internals certainly support more of the breakdown that we saw on Friday instead of being divergent and saying, no, you should fade this move back in the upward direction. Sellers are here, or you could even inverse the lens and say, as we made note on the hourly, right? If we were thinking about this look into the gap that failed, we just have no indication whatsoever that dip buyers are trying to step up near the daily 50 SMA. Just not the case at all. Let's jump on into the market profile for the ES and see what else we can learn here. This is interesting. You can see the A period and B period single prints here. That is thin structure overhead that we'll be mindful of. And for the most part, I really want you to focus on the poor low here. It sort of begs the question, it should be broken if tested. Let's say we open in range on Monday. It should, if tested, break. And then the question just becomes, do we make it to that daily line in the sand? In which case we're looking for a quick little reversal back to the upside. But for what? Only to spot a lower high where? Ideally, anywhere underneath 55.10 on the ES, right? So that is sort of what we're looking for out of the ES futures, and the poor low is the main takeaway here. You can clearly see that value and the point of control have all moved lower on Wednesday to Thursday, and Thursday into Friday, of course. We do have a lingering poor high up here from Thursday, but I would not really have that as a main watch if we're opening inside or below value from Friday on the subsequent Monday open. Let's jump on over to the QQQ and see what's going on with the Nasdaq side of the marketplace. We know that there's a lot of relative weakness here. Let's go up to a weekly time frame chart. Speaking of weakness, what do we see? Well, first and foremost, candle structure and location. Let's keep it status quo. Let's not deviate from the plan. Bearish structure lower high, lower low. Absolutely, bears are in control on the weekly bar-to-bar count. But unlike the S&P 500, we're not pulling back from an equal high when we're considering more context. This, from here to here, is a nasty weekly lower high, and this is a stretch in the imagination, but is it possible that instead of just a double top, this is starting to suggest more of a head and shoulders reversal pattern? Perhaps. Now, I would still argue you need to be underneath the neckline for that to become a valid trigger of the reversal, but generally speaking, this chart is much, much weaker than the S&P 500. If we think about where we're at from a Fibonacci perspective, from the low up to the high, we're at the 61.8. We're at the do or die level. There was clearly no support off of the 38.2. If we get any bars that close under the 61.8, generally speaking, the odds dramatically increase for a 100% retracement. And at that point, you're basically flirting with the neckline of that head and shoulders we just described. What about the weekly anchored VWAPs out of the NASDAQ underneath the entire cluster? And this is much more of an overshoot versus what we saw in the S&P. The S&P on a relative basis might have closed here compared to its anchored VWAPs. This is well underneath out of the NASDAQ. So much more of a threat here. This is where the bears want to continue hanging out, putting pressure into the market on the NASDAQ side versus the more broad and diversified, slightly, S&P 500. Let's quickly check in on the weekly volume profile and make sure we're not missing anything from this perspective. We'll go with the 9-month chart, just like the S&P, and we'll see what we can learn. I mean, just, this one was quite literally early on in the week, fading away from the high volume node, rotating through the low volume void, and we've even closed underneath the first major volume shelf. We're coming into this big congestion zone. So is it possible that maybe this acts as support to some degree? It's possible, but as we'll see on the daily time frame chart, there's really not much structure in here in recent market memory from the August 5th breakdown. So speaking of dailies, let's go there now. Back over to the NASDAQ. First order of business is the weekly expected move. So if we're contained by the upper bound here, it's at 462.49. If we're contained by the lower bound, it's 434.85. So you've got yourself just the continuation of a lower high. And of course, we are already underneath the daily line in the sand as of Friday's close. So this would just be a lower low as well if contained at the bottom. Bearish on the weekly expected move from the NASDAQ. So what does the chart structure tell us here versus the S&P 500? Well, we didn't really have a gap to contend with, maybe a little bit of a gap in here, but that didn't offer any semblance of support. We had multiple inside bearish inverted hammers inside of the Tuesday breakdown, offering a flush point, and that triggered. So not shocking at all to see the NASDAQ lower here on the breach of this key area of support. And as noted in the intro, that was your daily line in the sand for a higher low. At this point, I don't think it's fair to say that the daily trend from, let's say, point A down here to point B up here, which, by the way, did still make a new high over point C, right? It was a higher high. So the pullback was reasonable at first, but now that we're underneath this key level, which really is being defined by this previous balance range, I don't think it's fair to say that the NASDAQ daily trend is up. It's neutral at best, if not attempting to flip to down. Any subsequent lower high, and you're in a downtrend. You could probably even make the argument that you've got a downtrend, line here, and any sort of rally attempts, if they're early on in the week, that stay underneath 468.35. Keep the bears totally in control out of your QQQ daily. So let's get granular. Let's go on down to the hourly time frame chart. Let's see it. First and foremost, just like the S&P 500, the trend is down, right? So you've got all of these lower highs, 1, 2, big set there, 3, and you've got lows, lower lows, lower lows. The trend is down. You're sitting on the lowest low of the trend cycle. What are you coming into, though? We just talked about this equivalent on the S&P. It's the double bottom neckline. So do you want to be a brand new money short at 446.65? Probably not. I would tend to think that some sort of thin structure retracement is just a counter trend move in the context of this existing downtrend here, and we'll look to set up lower high rejections for shorts that look to exploit something like this, straight back down to the lows with minimal risk, in theory, up against this flush point at 458.50. That is going to be your key level to look out for an hourly lower high out of the QQQ. Maybe it's a double top, maybe it's a head and shoulders, maybe it's a simple inverted hammer, whatever it might be, that's the level that we're watching for. Target the equal low, 446.65. If we're coming into an equal low after a lower high has been set, then any breaks there should, in theory, open the door much further into something like, what do we have, 434.50, coming from the precise lows back here. And beyond that, you have the low from the August 5th move at 425. That would be a violation of the daily 200 SMA in green here as well. It is the opening print of what started this reversal, so maybe respect a little bit 441.25, but generally speaking, that downside path seems more readily available in the NASDAQ versus your S&P 500. So let's play devil's advocate. What if the market's going to reverse out of the NASDAQ, right? You would need to see, at minimum, some sort of higher low up and over that 458.50, if not better than that, with price acceptance over 468.35, which is really where this breakdown started accelerating from. I also want to showcase here that dip buyers did not step up at the key level. This 458.50 acted as support on the Wednesday session, and notice what happens here on Thursday. This is different than the S&P 500. We open over the level, and we actually break out, making a new 2-day high over Wednesday's high on Thursday at the tippity top of the session. Is there any sort of acceptance? And what would this represent, right? If you're putting your pattern trader hat on, what does this represent? It's technically the trigger of a double bottom neckline. Is there any acceptance? Is there any attempt to at least get into 468.35? The answer is absolutely not. So is that a strong indication of dip buyers stepping up? Absolutely not. So I continue to sort of reinforce the idea that we were in uptrends. It was very reasonable that this was a mild pullback after the ripping rally off of the lows. But as soon as we saw that dip buyers were not stepping up in this market, as soon as that Thursday session failed back down into Wednesday's range, I don't really think it's fair anymore to say that the market was trying to sustain some sort of higher low pullback in the context of a daily uptrend. Let's come in here with our intraday anchored VWAPs and see what's going on. So off of the August 5th low, you're underneath. Off of the Tuesday, you're underneath, of course, and both of those are confluence for a possible lower high up against the key level we've already described at 458.50. If we come in with the Fibonacci's specifically for this entire week's range, what else are we getting here? You've got the 38.2 right on the money at 458.50, reinforcing once again the idea that this should be the first thought for a possible lower high. Any accomplishment from the bulls above that start to change tone, but this is still a major threat. I would even argue a daily lower high could be set here, and perhaps, who knows, over time, your anchored VWAP could meet you there for confluence 468.35. So generally speaking, we know we're more bearish on the NASDAQ. Do the market internals for the NASDAQ also support this style or line of thinking? Absolutely. If we look at volume flows, out of the market totally on the Friday session. Under trend lower zone out of the advanced decline line, and a nice 45-degree line here out of the cumulative build. Not nearly as bearish as the Tuesday session, but bearish nonetheless. We can also read into the Thursday morning session. Recall that we were just talking about on the hourly chart, the failure. We made that new high. Was that happening on really bullish internals? Like, were dip buyers really stepping up at the exchange level, or was it more so neutral? Well, Thursday morning looks pretty neutral to me here, looks pretty neutral to me here, not in trend higher zone, and the cumulative tick was actually flat to negative on Thursday morning. So you're really not seeing strong indications of dip buyers trying to step up to preserve the daily trend that was up. Let's take a look at the market profile. If you're not familiar with the profile, I realized I did not link you to the tutorial over on the ES, but here you go, top right-hand corner's got you covered. Rinse and repeat. I mean, you clearly have value moving in the downward direction. Here's Tuesday, Wednesday, Thursday, Friday. Value is lower, point of control is lower. You've got a poor low. You've got A period single prints, B period single prints. All of the acceptance is down here. If you're looking for a counter trend move, one of the things you might pay attention to is the value area high. If you can squeeze out of that, in theory, you get any short late to the party on Friday who possibly say, maybe I didn't have the best idea or best location down here. I'm going to squeeze out. That possibly sends prices higher to test the lows that we're looking for, the more reasonable, tradable lower high to be set, right? And in the NQ futures, loosely around 18,850. Just to sort of recap once again that level in the QQQ Nasdaq, cash ETF, it would be 458.50. All right, so all set here out of the NASDAQ. Let's jump on over to the IWM small caps here and see what's going on. Weekly time frame chart will kick things off. I've got some concerns here. Small caps have been flip-flopping back and forth quite a bit with all the volatility we've seen. So first and foremost, I guess we'll keep it simple and we'll talk about structure, location, the whole 9 yards. You've got yourself a solid red-bodied bar, very similar to the remainder of the broad market, both the S&P and the NASDAQ. Really weak close, dead on the lows, no wicks. Great, bears are in control. Bar to bar, you of course have a lower high and a substantial lower low. Bears go 2 for 2. The issue here is that unlike the S&P 500 and more similar to the NASDAQ, you already have the threat of a weekly lower high, and you've actually closed underneath the top end of the previous balance range from over here. This is where we can start talking about the major balance and the micro balance. If this is the major balance, this was the micro balance, right? And we ideally wanted to see continued progress in the upward direction. Now, I'm not arguing that you can't still see a higher low on the weekly chart. It's technically possible away from the August 5th low. But after a lower high and failing more aggressively underneath these prior pivot highs, I'm not as convinced that this is going to be the case. I would not be shocked if small caps more so chop around in here and don't really provide any continued upward pressure for the S&P 500. If we look at some additional charts, we could go over to something like, let's go KRE first and see what's going on with regional banks. This is technically over 53, so this is possibly a back pocket idea to say, all right, not the worst thing in the world for the IWM yet. If the KRE gets under 53, I'd start to have much larger concerns, specifically in commercial real estate and the implications that's there. Let's move over to the XBI biotech. You can see that this is also putting in a similar pattern with not a lower high, but certainly a double top and threatening the major balance that we have underneath. And we can also take a look at the XRT for retail. This is already underneath the top of the major balance from underneath with a weekly close, right? So overall, starting to become wishy-washy, flippy-floppy on the IWM small caps. The whole, hey, we're going to avoid recession with this first massive push, and then the secondary follow-up push, you only get a handful of opportunities before it's like, okay, buyers are clearly tired here. You've got yourself a weekly lower high, any acceptance back in this range, and I would sort of, at least stay neutral, not say like, okay, it looks like we're going to avoid the deep, dirty R word recession, right? Let's get a little bit more granular. Let's take a look at the similar indications, starting with the Fibonacci off the August 5th low. You're at the 61.8, very similar to your NASDAQ. Once again, a breakdown there should likely bring you to the August 5th low, which is going to be confluence with your weekly moving averages. Green is 200, blue is 50. If we bring out the anchored VWAPs on the weekly time frame chart for small caps, you're starting to poke into the cluster. And keep in mind that the anchored VWAPs on the weekly here really speak more so to the monthly higher low thesis. I mean, this cluster and small grind in the upward direction is trying to sustain monthly higher lows from generally point A down here to point B cluster right up here. So if that can hold up, then great. But in the short term, once again, trying to understand the impacts for this week in the S&P doesn't really look great here. Let's bring this down to a daily time frame chart. Let's jump on over to IWM. Let's keep it really simple. We can paint with broad brushstrokes here. No pun intended, broad market, broad brushstrokes. What do we see? If the market was going to avoid the entire recession narrative from a small cap perspective, this acceptance should have been exactly that, acceptance in the top of this range after the August 5th panic. Now that we're underneath this on the hourly, we'll clearly see that as a double top. And I would say that we've closed right on the line in the sand here. I know on the weekly chart we had said, it's kind of closed underneath. We were using these highs on the weekly time frame chart. But if you look at the daily and the structure from back here, 1, 2, 3, support, resistance, breakout after the August 5th panic, this is your line in the sand. And we've closed right on it as of the Friday session. So what does that mean? If we are trading for a counter trend in here, I would tend to think neutral to bearish, noting that you have highs, lower highs, and a rejection overall of this overhead supply. If the market subsequently breaks under 207.80 and then makes a rotation that looks like this, that has to be bearish pressure for your S&P 500. The alternate outcome, right, is that early on in the week, there's just a straight up breakdown underneath the breakout point here, and that's instantly, like as soon as Monday or Tuesday, bearish pressure for the S&P 500. So I'm really not seeing a rainbows and butterflies style path forward for small caps to start influencing the broad market in the upward direction. Looks more like a threat currently than anything else. Let's take a quick peek at the hourly time frame chart and see what else we can learn about the price action here. The trend, of course, is down. This is the double top we were just referencing. As of right now, sitting on this as a slight bear flag into the lows of Friday. I would tend to think that, again, ideal short location, not here. You would look for a counter trend move to set lower highs anywhere under 215, ideally exploiting risk reward like this back in the downward direction, and subsequent breakdowns of this get interesting as follows. The Brigade bolt underneath. If this does just continue right out of the gates on Monday, I would say your lower high is tradable here, looking to exploit this range into 202. So that's what the bears want to see. And once again, this is really more of a neutral to bearish chart. If you're going to flip to being bullish on the IWM, you've got a lot of work to do. You've not only got to rally to 215. If there is a pullback, you need to preserve a higher low, and then you need to break over 215. A lot of effort is going to be required if that's to take place. Let's quickly check in on the intraday anchored VWAPs. You can see that we're under the entire cluster, getting a little bit of confluence out of 215, daily 50 SMA, multiple anchored VWAPs here as well. So you could get something like an arbitrary lower high on the hourly, somewhere around 212. If I had to pick out a level, it would probably be closer to 211.25. 211.25 represents the lows of the Thursday session, right? So that's your downside pressure out of smalls. We could also check in on the Fibonacci's from the top to the bottom. Your 38.2 is also around that 212. So 212, 211.25, that general zone could be, it's really not arbitrary at this point, but you could spot a lower high there to keep you bearish out of small caps, once again, implying downward pressure for the S&P. Let's jump on over to the Russell internals here and see what's going on from that perspective. You can see we had strong volume outflows getting right to substantially down, but not beyond it. You can see the advanced decline line is in trend lower zone, and the cumulative build is a 45-degree mark flattening out into the afternoon. I would say it's still overall more bearish than bullish, absolutely, at the index level. Let's check in on the Russell market profile, and it's a rinse and repeat, so no need to really rehash everything, but value lower, point of control lower, thin structure, as well as a little bit more of an excess low here out of the Russell, but still could use some repair and a much cleaner string of single prints off the lows of an individual session. Let's get on over to the sectors and really start diving through some more supporting evidence here for our broad market. Let's take a look at the weekly performance first. Who was leading, who was losing, and where was the weight? You'll notice that the TLT, which is not an S&P sector, but it was up the most, up 205 basis points, 2.05%. There we have it. Followed by real estate, rate sensitive. Rates were down this week. Not a shocker there. XLP, defensive, lightweight sector, up 0.56% as the market's pulling back. Does that seem like defensive posturing? The answer is absolutely. As we look at the laggards, I mean, the SMH just 1 basis point away from being down 10% on the week, down 9.99%. Wow. An absolute train wreck there. We'll talk about the major pattern that's in play. XLK, the tech sector, the heaviest weight risk on sector, down 6.46%. Energy, lightweight, but we know that there's some issues right now with crude, down 4.21%. This market doesn't look great, healthy, I should say, from a risk on versus off perspective as the pullback has taken place, and we're trying to navigate, okay, is the daily trend going to remain up? These are the exact same red flags we talked about on Wednesday, continuing to get worse into the end of the week. Let's check in on the structure. So the TLT trying to make a break up towards these highs. Nasty inverted hammer printed on the daily time frame chart. Any pullbacks here are fine. We know that the general assumption is that the Fed's going to cut rates. Bonds should catch a bid, right? So no shock there. Let's jump into real estate. Obviously rate sensitive, hanging out near the highs. It's such a lightweight sector. Obviously, it's not saving the day for the S&P 500. That's a great illustration. Same comment over here out of the XLP, defensive sector. It's hanging out near all-time highs. It's not really breaking down aggressively. It's lightweight. It's defensive. Doesn't matter. Your market's going to move lower as long as things like semiconductors and tech are absolutely taking a beating. So if we were looking at the SMH on a zoomed out perspective, we're starting to really suggest here's a man ray pattern. Right now, we're not underneath the August 5th lows, which is an equal low neckline to what we had back here in the April pullback. But generally speaking, we were sort of given a gift from semiconductors, right? As we look at the August 5th rally back in the upward direction, there was no lower high that was set underneath the bottom end of this balance. Recall that this was a major threat after August 5th, and it just didn't take place. As a matter of fact, a lot of this price acceptance started to suggest that, okay, we're actually accepting in range, if not slightly above range. So to see Tuesday and then really Friday put the nail in the coffin, getting back down underneath this 228.50. Look at the Wednesday and Thursday upper wicks rejecting this area, the bottom end of the previous balance, the top end of this breakout back here. Really, concerning out of semiconductors, especially if you were to zoom out and call this a weekly lower high. Any sort of equal low attempt, another lower high is easily sustained underneath 228.50 this go around. So let's say something that looks like this. Now you're dealing with threats to clearly move through the neckline. That's got to be more of a risk-off and bearish sort of implication for your S&P 500. So major concerns here out of semiconductors. And we can basically rinse and repeat that same sentiment over here out of the XLK. The left shoulder is not as well defined, but you still sort of get this kind of sloppy idea. Maybe there's the head and shoulders, man ray pattern, whatever. Same concept. Look at the balance range, look at the acceptance and mild pullback at first that was above. As long as we were over 218, the whole sentiment was, hey, this really isn't that bad. As soon as Tuesday aggressively broke down below that level and even closed underneath 212, look at once again the rejections on the Wednesday, Thursday, game over. You cannot maintain a more bullish stance if the heaviest weight risk on sector is not holding up over the must hold level in here, and once again is still suggesting something like a weekly lower high. So some pretty brutal breakdowns and bearish developments inside of the sectors that matter. Here's the energy sector moving in the downward direction. The XLE isn't really reflective of what I want you to be paying attention to. It's more so the CL crude. Look at this, making new swing lows underneath these lows over here, right at, actually even underneath as of Friday, underneath the major low of December in 2023. So this sides more so with what we were talking about over in small caps. The recession theme is going to pick up if there is generally global weakness around crude. So not great out of the XLE/crude. Industrials breaking back down into the long-standing balance range, this right here. This breakout in a picture-perfect world would have held a higher low over 128.25. Clearly not the case. Slightly more bearish. Lower highs can persist here and continue to put downward pressure. Let's take a look at communications. Never able to break out in the first place and also not able to hold a higher low over 85. Picture perfect would have been something like this and a subsequent Brigade bolt into the future over the all-time high. Not the case. Bearish pressure. XLB materials, the lightest weight sector. It's not going to move the needle, but it's back in the midpoint of its overall balance. That's neutral to bearish. Next up, we've got financials. This is still bullish, noting that we have the all-time highs previous at 44. Nice, strong breakout coming in with a vengeance for a possible test, and we're really all eyes on financials for a potential higher low. If you can find buyers off of 44, you probably slow down the bleeding a little bit in the S&P 500 as a whole. It's not going to completely erase or counterbalance what we talked about in semis or tech, but it will at least help alleviate some of the downside. Here's the XLY, discretionary, falling back down into its major range as noted by that 185.15. This is bearish, and once again, note the possibility of a weekly lower high. Healthcare is hanging out near the highs, pulling back, a little bit more similar to financials. Ideally, this would hold up right here, right now, off of 154, noting the three equal lows from in the past. Unfortunately, the candle structure does not look all that convincing. Just like, just to be transparent, it's not like in the XLF, this is a glaring sign of a higher low is ready to come, right? Ideally, you would print some kind of hammer here that maybe looks underneath 44 and then moves back over towards that all-time high. So we're not in the clear. It's not like we've guaranteed these higher lows, but the structure is at least more healthy in the XLF and something like your XLV healthcare sector, which, by the way, this is the third heaviest weight. Financials are the second heaviest weight, right? Let's finish it up with the XLU, the most bond-like sector. You can see that we've got 75 potentially as a higher low. It's lightweight, it's D for defensive. It still looks more so like risk off instead of risk on. Let's check in on the actual ratios of these charts to see what else we can learn about the sectors. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. You can see that the tech sector continues to be a red flag, making a new lower low underneath the last pivot back here. That's risk off. XLF is the only good-looking chart on this screen. XLY is okay, but really more so sideways than constructive for anything bullish. We know that the healthcare sector is D for defensive, so as it's outperforming, it's helping keep the S&P somewhat afloat, but it's not really the leadership we want to see. If we look at the XLP outperforming, if we look at the XLU outperforming, that is much more of a risk-off indication. Let's jump into the specialized ratios, and all of these are pointing in the downward direction. So bonds relative to the tech sector, much more attractive. That is risk off, generally, seeing this move lower, right? If we look at utilities relative to the tech sector, moving in the downward direction, once again, more of a risk off indication. The whole concept was that we were looking for higher lows here. We were looking for some sort of like maybe mild pullback to get to the blue line. Not the case. Not the case. Let's check in on apples to apples. This is XLY over XLP. Maybe a possible higher low in here, but generally back down underneath the blue line. No good, risk off. As we take a look at semiconductors versus healthcare, you can see the underperformance of semiconductors. Once again, more of a risk off indication. Now down below, we have the Japanese yen. Let's maximize this for a second. You'll note that we've made a new closing low as of Friday's session, certainly continuing to put the downward pressure on US markets as a whole. But remember, you really want to keep tabs on the Nikkei as well. Let's go N225. JP is what we want out of that. Y225, if I could get the right number. There we go. And we can even flip this to a candlestick chart just so we can make heads and tails of what's going on structurally. Look at the pullback. Look at the breakdown in here. This Tuesday this is the overnight move, right? This is kind of what puts the pressure on those US markets. And I would say any sort of movement in the Nikkei underneath this 35,265, that's going to get fairly ugly. I would really start arguing for like the yen carry trade coming back to the forefront of the conversation. Make sure you're keeping tabs on this. As a matter of fact, a very simple thing you could do is just set an alert directly underneath. I'm going to do it with you here together. At or below, let's go 35.1 flat. All right, and that is going to do it for me. Now that that alert is in there, we'll be alerted and we'll take a look. So that is certainly risk off, noting that this market is moving lower, right? Let's continue along. Speaking of currencies, to the dollar. The dollar is continuing to drift in the downward direction overall, which makes sense, understanding that rate cuts are on the horizon, impacting what we have over there. So let's take a look at interest rates. The 10-year, seeing a nice little continuation move to the downside. Now, in theory, we want this to be a slow move in the downward direction. Remember that bond volatility, interest rate volatility spells volatility for the marketplace. So this was actually more aggressive than what I would have liked to see if we were going to have a nice respectful higher low pullback start to emerge out of the S&P. This sort of malaise in the downward direction here is really more appropriate of what you would want to see as this is possibly taking place. And the whole reasoning behind this, right, is we know we want to avoid the situation where the Fed is hitting the panic button and like offering a double cut, a triple cut. Oh my God, we have to save the labor market. So let's start taking a look through some of the fundamental data as we're sort of bridging the gap with rates. Here's the inverted ZT, basically the 2-year interest rate, which the Fed closely mirrors, basically, forecasting that, yeah, this big double cut is likely on the horizon. However, what does the Fed tracker tool actually say? Let's not speculate. Let's take a look. And as we come on over, we'll see that the odds actually increased for a single 25 basis point cut. This, to me, is a bullish indication. I think that as long as the market continues to price in appropriately a single cut and not a double cut, there's likely going to be less of a chance, and again, who the hell am I to talk, but I think it would be a massive policy misstep if Jerome Powell cut twice. Now, if you're actually paying attention to the calendar and some of the speakers, I think if we scroll down, we had Waller. Waller came out on Friday and said that he would prefer, he'd prefer to front load rate cuts with something like maybe a 50 basis point rate cut, or dare I even say it, something like a 75 basis point rate cut. I think that that would be a mistake, noting that services inflation, as we've been talking about on the channel for a very long time now, has remained sticky, and housing services is still on an uptick. So that was Waller's commentary, and I'm actually pleased that the Fed tracker tool, the market is smart enough, hopefully, to be pricing in sort of my thesis here, which is that a slow cutting cycle is more advantageous for the equities market. If we take a look at the data that actually came out last week, we know that JOLTS came in light. This is not a good look. It means less jobs are available. As we look at the ADP non-farm, it came in lighter than the expectation, 144. We got not 199, but rather just 99,000, and the previous got revised down big time. And of course, that set the stage for what was likely to come on Friday. Now, before we get to Friday, I do want to sort of reinforce the idea that unemployment claims on Thursday were actually amazing. Killer read, you beat the initial claims, and you also saw continuing claims see a downtick. Let me see if this is the proper chart preloaded for it. It is. So here's initial jobless claims, the 4-week moving average in blue, ticking down, which is what we just saw as we beat the expectation. But more importantly, continuing claims moved lower as well. And recall from last Saturday's update video, if continuing claims do not see a hockey stick move in the upward direction, it's very difficult to call for an outright recession. Now, there's a lot of conflicting data, and this is only one piece of the puzzle. Because if we go back on over, let's just take a look at this. Oh man, I'm sorry that these things were not preloaded. This is services PMIs from ISM, and the main illustration here, this came out on Wednesday, or was it Thursday? It was Thursday. But generally, look at the yellow line and the blue line both moving in the right direction. It just means that you're not getting inflationary pressures. If those were divergent, services inflation would be more of a big deal. Let's jump into this one and see what's up next. This is the non-farm payroll. This is the official report from the Friday session. So let's jump over here just so we can make heads and tails of stuff. Hourly earnings came in slightly hotter than the expectation. 0.4 is not really what we want to see. We want to see 0.3s and 0.2s. You can sustain over a 0.2 because hopefully people are getting paid more than inflation, right? And you really need those 0.2s and 0.1s to get CPI annually to 2%. So generally that's okay, but the 0.4 needs to be an outlier. It needs to be an anomaly. Otherwise, you fall into possible pressures on inflation based on wage price spiral. As we look at the non-farm payroll, the official report came in lighter than the expectation, which once again was not a shocker considering what we saw out of ADP. Let's see where those jobs were actually added, because on Wednesday, we had talked about how the professional and business services side was where the most JOLTS, job openings, were. You really didn't fill those slots, not very aggressively here on the actual breakdown of where the change came from. So sure, you're up month over month, but nothing substantial here out of the non-farms. It would be much more advantageous to see this number much larger here. It would be better to see information's, much higher. Construction's decent, indicating something, some sort of the cyclical side of the economy is doing okay here. So we'll keep tabs on that and expect leisure and hospitality to downtick as soon as we start moving into the fall and winter months. You're just not going to get, the summer season's over, so expect those to sort of contract a little bit. We want to see the jobs added in these segments here, and construction is good as well, once again, with that cyclical side of the economy. So that's the breakdown of the NFP. And let's jump back on over. The unemployment rate is also very interesting. So we were expecting this to move down, and we sort of talked about it live on Friday, but generally the expectation was that if initial jobless claims were down, if continuing claims were down, then we should expect the unemployment rate reasonably to come in at the 0.2. And for those of you who are maybe not familiar, this 4.2 comes from a rounding error of 4.22. Last month's 4.3 comes from a rounding error of 4.26. So you didn't really jump a full, 10 basis points here. It was really like you jumped 4 basis points, right? So keep that in mind. These numbers, the headline number is never going to be reflective of what's actually going on. But generally what I want to show you on this one is if we jump into another chart as it loads up, there we go. This is the unemployment rate broken down by different segments, right? And the biggest takeaway here is the downtick comes from, if you will, on temporary layoff. Look at the blue segment prior month versus the blue segment this month. I would say that a majority of the downtick this month, if you're just sort of like connecting similar slopes, actually comes specifically from on temporary layoff, which is something that the BLS noted with Hurricane Beryl. I was a little bit skeptical of that, but seeing it reflected in the data, and we can go down the rabbit hole of, the data's cooked, it's this, that, it's the other thing. It's the data we have in front of us, unless you want me to make something up, right? To me, it is sort of reflective and reinforces that, okay, maybe that was a reasonable sort of expectation to set. Now, before we jump into earnings, because that's the next fundamental talk to have here, I do want to bring up 2 additional charts back inside of the platform. Number one is that the 10 2-year curve actually started to re-steepen over the zero line on this information into the end of the week. And that's fairly important because typically when this reinverts, or gets back over the zero mark, I should say, you tend to see pain in the market, especially when paired with a fast cutting cycle. All the more reason to not want Jerome Powell to take his let's avoid the 50 basis point cut. That's basically what I'm saying. As this re-steepens and the Fed starts cutting aggressively, great financial crisis, right? You can see we re-steepen, pain. You can see we re-steepen, dot-com era. It's not a slow cutting cycle, pain, right? So as this re-steepens, let's please get a slow cutting cycle, Powell. And I would say that the labor information we just got is totally supportive of more of the slow cycle. Yes, the unemployment rate is a little bit elevated, but continuous claims are rolling over. There are still jobs technically being added to the economy. It's not like we have negative like job loss out of the non-farms, right? So for me, the fundamental data supports more of the slow cutting cycle, which, to tie it all back to like trading and the market as a whole, more supportive of continued upside, a grind, maybe a little bit of sideways balance, but generally still optimistic about future outcomes. If things really deteriorate further, that's excuse me, where we start to say, all right, recession in a fast cutting cycle, no good. We're probably looking for major downside. There was an additional chart I wanted to share with you, which is the SOM rule, which has been talked about a lot recently. Even though we saw a month-over-month lower number come in, remember it's a rounding error, but 4.2 from 4.3, the SOM rule had continued to accelerate over 0.5, which triggers, or historically speaking, has been pretty darn accurate on triggering or suggesting when a recession is likely to take place. I did want to make that note. And once again, all of these data points need to be considered in reference to each other. You can't just look at this and say, oh my God, a recession's here. You can't just look at continuing claims and say, nope, we're going to avoid it. A combination of all of them is likely what gets you to the truth. Some sort of blend of all these different metrics. Let's jump back over to the calendar, because before we get to earnings, I do just want to prepare you for the days and times that are important this week. CPI inflation comes out Wednesday, September 11th at 8:30. We will have coffee and donuts up in the penthouse. It's going to be followed up on Thursday with PPI, 8:30, and the unemployment claims as well. Initial and continuing, we'll keep an eye on how those are released. And then Friday, although not flagged as a Red Star event, typically the University of Michigan preliminary sort of surveys are the ones that move the market. So please do be prepared for Friday at 10 o'clock. Jumping into earnings, we finally got a new report from FactSet, and I do want to dive into a couple of the things here. If we take a look at the revisions, sector level revisions on Q3 earnings between June 30th and August 30th, notice that information technology is not revised down by any stretch of the imagination. That technically, in my view, means that analysts are still optimistic about the outlook of technology. I mean, those are clearly companies like Microsoft, like Apple, like NVDA, the one stock to rule them all. So no downward revisions there, versus a whole myriad of other sectors getting downward revisions. The net effect for the S&P 500 is down 2.8 on those revisions. As we take a look at the bottom-up calendar year 2025, though, I found this to be really interesting. Information technology gets a big boost at the top of the list, up 1.9% on the revisions between June 30th, August 30th. If you look at financials, nice up move here as well, 0.9%. We know that financials are right now driving a lot of the return, or at least keeping the S&P stable. And then the downward revision comes from energy. So energy, industrials, consumer staples, materials, these names, real estate getting downward revisions, in my view, really isn't all that bad if we're still pretty optimistic on the infotech bull run continuing into 2025. Generally speaking, again, this speaks to sentiment of analysts, big banks, big money. Where is capital allocation? Well, if analysts are seeing infotech doing well, why would they want to peel out aggressively? So we'll keep tabs on the technical charts, but I did find that to be quite interesting. And then the next thing I really wanted to highlight, bear with me as I scroll down to the bottom of this sort of move here. Here we go. The growth chart. Look at the growth out of financials. This is earnings growth for Q2 in 2024. Once again, is this overly indicative of recession being right around the corner where financials are doing really well? Probably not. Infotech even beat as well. Utilities, huge beat over here. If we look at one of the only, or it's two sectors that really underperformed, you have communication services. Not really the best look, remembering that Google is kind of in there. We want to see them outperform, but generally that underperformed, and you can see here energy underperformed as well. And this is for Q2 2024. As we look forward to, let's go to the next one. I think I got to scroll down to not profit margins. We want to go to, here we go, Q3 2024 growth. Let's see where we're seeing the move. So infotech still looks fine. Healthcare gets revised down. What does that represent? Well, is it possible that the defensive sector is not going to lead anymore? What about financials? Flat. Not seeing anything out of financials on that. Let's jump into, do we get the 2024? I want full year calendar. Here we go. Calendar 2025 growth. This is, again, speaking to how do analysts feel about these sectors? Still bullish on infotech. Still bullish on financials? No. So really the main watch walking forward here is that you can't see the XLK break down the weekly trend that it's established so far. We know if we just go back over here, I know we're jumping through the charts, we're spending a lot of time today on the fundamentals, but if this is going to be the case, if analysts are going to be bullish infotech, you cannot afford to see this chart in the near-term future underneath 192. So my view is that if this consolidates in here, maybe we just get something like range compression out of the weekly, and then we resolve it higher once we get through some of the unknowns. Thinking about things like Fed rate cuts, thinking about things like the US election, right? That's a possibility. If we're underneath 192, I would throw all of those analysts' expectations to the wind and say, you know what? This is clearly an opportunity for a downtrend, probably going to spell pain in the S&P 500. So that's the main take out of that as we look forward to earnings this upcoming week as this chart loads up. Where are we? Here we go. Oracle is the top watch. This is really all I've got for you. Get your popcorn out if you want GameStop. We're going to skip out on that one. But Oracle is interesting. Maybe Adobe as well. They always have some comments about the AI side of their products. So if AI is of a big deal to you, Oracle and Adobe this week. Monday after the close, Oracle. Thursday after the close is going to be Adobe. Let's get the job done. Let's finish this thing off and let's move along. We've got the TLT ratio to the S&P. The reason I want to bring it up is because of the major uptick that we've seen, the major outperformance. This would be more of a flight to safety style indication. Makes sense to me based on what we're seeing. And once again, I've talked about this in previous episodes. If we make a new swing high, I would not be bullish in the S&P 500 as much anymore. Let's jump along to the bonds relative to themselves, continuing to migrate in the downward direction, all set there. Let's jump into wrong lineup. Let's get into credit spreads. They're starting to accelerate once again in the upward direction, but nothing major like what we saw out of August 5th. So still remaining somewhat reserved over here. And the only bullish chart I have up my sleeve is the HYG, junk bonds. Why would junk be trending in the upward direction if market participants felt as though a big, deep, dark, dirty recession is on the horizon? This is the last place you want to be if you think that the economy is headed to, into the toilet and a recession is looming on the horizon. So junk bonds have a positive divergence, and this is just off of the lows. You spot yourself a nice little higher low. Great. Look at the S&P. It's got a lower low. But what about corporate grade bonds, LQD? Corporate grade bonds made a new higher high. So, the point of this red line is not to call for resistance. The point of the red line is to just say from here to here, we've got a higher high. The S&P 500 is not even close to its highs over here. And yes, you also have the higher low as well to pair with it. So generally speaking, this is one data point for the S&P 500 in particular, where I say, wow, this doesn't really add up. And I think you could also look at something like the AGG, which is the aggregate bond ETF. And I believe if we go to a 3-year chart, yes, this is new 52-week highs. New 52-week highs into the beginning of September. Once again, ask the question, if market participants were scared of a recession, why would sort of an aggregate corporate bond ETF be performing in the upward direction? Probably want to stay away from something like aggregated corporate bonds and more so go to government backed with something like, the 2-year or whatever. So anyways, bond-wise, right? TLT, even it's just a very simple, better alternative. So that to me was somewhat interesting over here. Let's jump into our Bitcoin chart. This is slightly more risk off breaking down. Let's jump into the total breadth, making a move in the downward direction out of the moving averages, as well as your new highs versus lows coming into zero. As long as we avoid a look like October of 2023, again, still maintaining some optimism on the weekly for the possibility of a higher low. Let's jump into the RSP, which does not look great, breaking down underneath the previous highs. We had talked about this on X quite a bit. So under 172.50, I would have to be more reserved for the broad market. If this makes a miraculous recovery and a Brigade bolt higher low over 172.50, back to being bullish over here, probably trying to scout some sort of higher low setup opportunity to take it long, even if it is only for a counter trend move into the bottom end of the range. I would love to take that trade if the RSP is over 172.50. On again, it would require pretty impressive recovery at this point. Let's jump into the QQQE. Not much of a divergence over here. It's pretty status quo. We know the Nasdaq is relatively weak. Let's jump into the VIX. Volatility is elevated here. I think it's going to stay that way with the CPI print and PPI print this week, Wednesday and Thursday, as we just made note. If we look at the VVIX, it's also elevated here up and over 103. It never really pulled back aggressively into comfort zone at 75, and we could say similar things over here on the volatility futures, getting closer to a backwardation, not there yet. monthly and 9-day VIX, definitely right on the cusp, right? And this is where it becomes non-advantageous for money managers to allocate capital today versus waiting for some point in the future. And the same thing would hold true here if we get into negative territory. I want to look at the 1-day VIX as well, because yes, there was this big acceleration. We made the move back down to 745, but now we're right back consolidating over 1275, which, we know this is where the market's on edge. So if you're over 1275 out of the 1-day VIX, don't think for a second that it's game over and the market's going to grind back to new all-time highs. It would really require a sustained period of time underneath 1275, which we just currently don't have. We can check in on the skew because we talked about it on Wednesday. This did come back down. This measures sort of tail risk event, event risk, tail risk event, coming back down. 30-day plus out options, the call put skew is coming down, meaning that people sort of bought whatever they wanted to buy far out. They bought their insurance, and so be it, right? And it's not like people are continuing to send this thing higher into the upper handles around, what do we have, 170. So the black swan indicator settling down a little bit. It's much more in this comfort zone of the balance it's been stuck in. Earlier on in the week, it was above, right? We talked about that Wednesday. So that is the breakdown of your supporting evidence. Let's jump through the hoops of the core list of companies. Starting on dailies, we'll work our way to hourlies as well. Apple is suggesting a possible lower high underneath the balance range. Here you have highs, possible lower highs, failed back down underneath the 50 SMA on the daily time frame chart, now we can move to the hourly. Rejections of this 222.50, equal low should be the target, and anything beyond that opens the door to 214. If the market is going to turn this into a constructive double bottom, number one is that you've got to get at least over 222.50, but likely you need the break up and over 225. Let's go 15 for the sake of round numbers. You guys know me, and we'll actually even make that a little bit more dim as a deeper gray. It's not as critical being inside of this balance. So if it's bullish, it's got to put in a lot of work, consolidation here, and then some sort of break. But as of right now, this is the primary outcome. Looking for this trade here, A to B, into the early stages of the week. Next up, Microsoft daily time frame chart will kick things off. Similar concepts, lower highs, lower highs, lower highs, breaking down underneath this previous area of support, which even before that was resistance. This is bearish consolidation. Anything that's underneath $400.75, look left, thin structure through the August 5th breakdown, or gap down, I should say, and that target would be at 389.15. Here it is on the hourly time frame chart. Bear flag, again, consolidation down here, rallies and lower highs under 408.50 are good to go, so looking to exploit risk reward like this in the downward direction. If it's just consolidation, arbitrary lower highs and there's nothing to do, then this is what we're looking for. Risk reward boxes look something like that into that 389.15. Once again, that's this right around in here. Looking left, there's your thin structure and volatility from August 5th. Let's jump into NVIDIA, the one stock to rule them all. Daily time frame chart to begin with. Inside inverted hammer on Thursday, starting to resolve lower on Friday. The only issue I have with this chart is just the congestion in this zone from in here. So a little bit cautious through this area. If there's some sort of attempted move back over 103.75, I think you could get a little bit of a short squeeze. Not saying that this thing's going back and it's going to flip into an uptrend, but I'm thinking that short's late to the party here. If we get some sort of higher low over 103.75, I would tend to think a rotation into the top end of this range is totally reasonable at 109.50. So that would be a watch there. The even better long trade is like, okay, ignore this. It's just consolidation. But this, apologies for the vocal issues, that would be a thin structure retracement. My goodness. Really sorry for that. It's pretty rare that this happens in a weekend video, but little Fiji water here. And let's try that again. A little bit of a move over 109.50, and that's where we can get a thin structure retracement into 115.75. For the sake of giving the voice a break, let's keep it simple in the remaining charts. Google daily. Breakdown, new lower low. Bears are in control on the daily. Lower highs under 156.50 fly. Anything that's to the downside has a gap to close. 146 down to 143.50. My personal preference here is that Google should see a counter trend move. I thought that Google on Friday was a great short. We participated in the Discord. Kudos if you took the trade and sort of followed along there. But generally speaking, we're at a target. So I would think that after making a level-to-level move, a counter trend is not unreasonable. We'll look for either a lower high here. We'll look for an arbitrary lower high, and anything that passes through, we just talked about the gap close target underneath. To be bullish on Google, you need to see a higher low over 156.50 to get back into the original range. Let's move along to Nancy, Amazon. Daily chart leaves a bit to be desired, pretty sloppy in this area. We sort of cleaned the chart up quite a bit. And just noting that there's not much to comment on there. This is really just a balance range. The most constructive trades are underneath 171.50, looking for a breakdown. I would probably argue this gets you started, and then a breakdown under 168.75 is paramount because it represents this from the earnings gap down. So step number 1, step number 2, and then we're trading for downside outcomes. If you're just chopping around in the range, it's a range trade until proven otherwise. Maybe you could say something constructive about this to the upside, but look at where we closed on Friday. Next up, we've got the metaverse, and I'm going to have a heck of an editing job to do. We've got a big bearish engulfer, and we've got a 503.50 level, and we, of course, are looking for further downside. I think that any lower highs can be set underneath 514.75. I think that anything consolidating here that then breaks down is really looking for this top end of the balance. If we just bring it down to the hourly, this is a pretty aggressive move on Friday, indicating that the sell side momentum is here. Once again, lower highs underneath what would have been the neckline of the mosquito pattern. Notice where we opened. In theory, buyers could have had a higher low here. Didn't take place. Indicates that the sellers are really here and in charge. So lower highs are the name of the game. Bearish consolidation here is the name of the game. Looking for downside to really flip bullish out of Meta. You would need to get back into 514.75 and then break Brigade Bolt over 524.25. Next up, Tesla. Let's take a look at this daily time frame chart. Big bearish engulfer down 9.4% on the Friday session. Incredible. It really leaves a bit to be desired. If I'm being honest, like the daily chart is kind of sloppy in here. There's definitely bearish momentum, and you are rejecting this kind of equal high. It looks to me like a failed double bottom breakout over that neckline. So here on the hourly, we can start to maybe, bring in some ideas. Bearish consolidation here sets up this. Any continuation sets up sort of like looking for a counter trend, noting the magnitude of the move into 210, lower highs there into the future. If this rallies up and over 215.25, I would tend to think you could get a thin structure retracement. I would take a trade long from point A Brigade Bolt higher low above. I would ideally target something like B up here, but my goodness, please manage your expectations. At the first sign of weakness, noting that it was down 9.4% on Friday, you've got to be willing to bail, right? So even if you don't make it to B, you've got to spot tight enough risk reward down here that even if you make it halfway, you've got something like a 2-to-1, 3-to-1 on something like a 5 or 15 minute time frame chart. So that's Tesla really taking this in stride after that after that bearish momentum on the Friday session. JP Morgan, unlike the financial sector, it's underneath its retest area. It's testing the daily 50 SMA, but now I think the idea is this. If you can spot a lower high under 215.75, you might continue this pullback. Not the worst thing in the world. I would tend to bring out the fibs and see where we're at from that perspective, right to the 38.2. So if this rallies and then rejects underneath these lows, that's where the breakdown to the 61.8 comes in, which is also confluence with this breakout point, 203.75. If you were to get a rally that then Brigade bolts over 215.75, previous highs from 1 to 3 interactions, that would be a long backup, ideally into the all-time high, like from a larger time frame daily perspective. Hourly chart shows us some pretty thin structure, so it's not unreasonable that this counter trend move happens. You could look for something like this on the Monday session, A to B. Please reevaluate at B and possibly entertain the idea of a lower high there. Equal low breakdowns bring in that larger downside, and something that looks like this brings in that larger upside. This really unlocks the move to the all-time high. Next up, Netflix, really more of a balance range breakdown. This is a failed daily bull flag, something that was looking like this. There was your flag range. You could see on the Thursday session, we opened underneath. Okay, looked good. Started with another open there on Friday. The watch was really for something over 685. No dice from the buyers, and instead you get a breakdown more firmly of the bottom of the range. You came into the previous congestion from back here. I would tend to think that this is a reasonable outcome. This is a reasonable outcome. If you're going to be bullish on Netflix, you could try for a point A to a point B, but generally speaking, this is really what's required. Get back inside of the flag range, prevent this from being overhead supply along over 679.25 maybe is worth entertaining. AMD is up next on the chopping block, last but not least in the core list of companies. Daily time frame chart, it's in sort of a congestion zone, so I'm not thrilled with that. AMD's been a tough one to trade recently anyways. I'd say that Google was really the trade of the week, but Let's go back to the hourly. These inside bars don't really tell us much. This breakdown would just indicate that the sellers are building their edge. So lower highs under 136, basically Tuesday's low. That would be a watch, something that does this into the equal low of Friday, if not this structural support from back here at 130.75. Anything underneath that, I mean, my goodness, talk about a thin structure retracement. August 5th low is in play at 122. To be long AMD, what would you want to see? Maybe something that looks like this into the future, but I mean, it's just such a stretch of the imagination. I really would not want to interact long over 136. I mean, you could make the argument that it's a look below and fail, but the trend is down here. This is lackluster price activity. I really don't want anything to do with AMD in this range until it builds out cleaner structure. So that is going to do it for the core list of companies. Let's get into this one additional idea, and then my goodness, I'm taking a break from talking for the next who knows how long. DLTR, Dollar Tree, DLTR. There we go. Let's take a look, and the requirement here is that we go to a monthly time frame chart and we go out to max available. This is a huge opportunity, I think, for the it's a huge opportunity to watch for whether or not buyers step up. It's a multi-year inflection point. 1, 2 loosely, 3 coming into it for 4, previously resistance, just below a little resistance as well. Multi-year inflection point coming from the highest high. This is basically a round trip, 100% retracement. This move is an absolute waterfall sell-off. So is it possible that, even if it's just a counter trend move, is it possible that you get something going here off of the 60 handle? It's possible. So let's take it to the weekly chart. The weekly bar does not really look all that great, but look at the lower wick that's starting to form. I think that this is a chart you could watch to become constructive over time. Is it possible that you start building out some sort of, flat rounded bottom over the course of the next 2-3 months, right? If we take it all the way on down to the daily time frame chart, if you want to day trade this thing, I would say that the gap close overhead from earnings is really what you're looking for. If 60 is going to hold as a key area of support, let me zoom back in here, and we can take out the earnings gap down open at 72, let's say 90 for the sake of round number, and we'll make it yellow for our typical gap color. If we could do that, and then the trade would be, my goodness, up into 81.35. And we're really going to wrap it up on this. This is a longer term idea. There's really no shorter term ideas that were attractive when going through the scans today. So not much to comment on. I think that it's continuing to watch the broad market, getting direction there, as well as the core list of companies and seeing how the tech side of things play out versus your S&P 500. That's going to do it for today's episode of the weekly watch list. I'm going to go get some honey, hot tea, and give these vocal cords a little bit of a rest. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Remember, we'll be live every morning, 8 o'clock this upcoming week, including coffee and donuts for the CPI and PPI reports up in the penthouse. We'll see you here live on the channel, 8 o'clock each morning. With that said, have a green trading week, and I will see you in the next one.